So that's one of the issues. The other issue in US is the still decreasing housing prices. And the third one is about the rise in the petrol gallon price, which also is a problem. Maybe we can switch to next. The next slide is about Japan. Japan is the other big developed economy. And for Japan, the situation is a little bit mixed in the sense that we have positive elements. This year, we're expecting a growth of 1.8% after recession in 2011. We see more orders, machine orders, so there's definitely a trend up. The export should also increase. And the activity is also largely underpinned by public investments in Japan. And you know that after the earthquake tragedy last year, eventually the government has voted a budget for the reconstruction of the damaged areas. So it should help boost the economy. And also we see a reduction of the business insolvencies in Japan, as well as a reduction of Coface, an improvement of our payment experience in Japan compared to last year, which was already pretty good. But, because there is a but, there are also negative elements. The businesses are facing an increase in energy prices. As you know, most nuclear plants have stopped now, so Japan has to import a lot of coal, a lot of alternative energies, and that costs a lot for sure. The reconstruction is starting very slowly. The household disposable income are still under pressure, and people are saving a lot of money. That's a tradition, but the saving rate is up. And last, the supply chain has not yet recovered fully in Japan after the earthquake last year. Next slide, please. So, I mean, probably we can switch directly to the next slide because I won't repeat this. That's already what I said. That's a summary, so you can switch to the next slide, please. Yeah. So that's the current situation, our country risk assessment at the end of April 2012 for the developed economies. So you have a mix, but the general trend is that they are more, I would say the trend is more going downward than upward for sure in that part of, in that category. There's probably only for Japan where we put last year Japan A1 under negative watch because of the nuclear and earthquake catastrophe, but now we have withdrawn the negative watch. But all the other, especially the countries in the Eurozone, most of them have been downgraded, especially Greece or Spain or Italy. Okay, next slide, please. So now we switch to the emerging economies. So probably what I will say is probably a kind of repetition of what has been said before. There is obviously resilience from the emerging countries. 2012 will be a year of decoupling in the sense that on the one hand, you have a very, very low growth or even recession in the advanced countries. On the other hand, the emerging countries are posting dynamic growth despite a certain slowdown. So that kind of risk reversal trend has been experienced in the last 3 years. We are optimistic on emerging countries because we have the experience of what happened in 2008, 2009. And these emerging economies could handle contra-cyclic policies thanks to low level of public debts, to significant foreign exchange reserves, and thanks also to better governance. So we don't see a reason why, if situation was deteriorating further, these countries would not be able to do the same. So it's particularly true of emerging Asia, where we predict a 6.8% growth in 2012 after a 7.4% in 2011. It's less obvious in emerging Europe, Central Europe and Turkey, which are closer to Western Europe and so more vulnerable to Western Europe turmoil. Okay, next slide, please. So we see 4 main risks in emerging countries in 2012. First is the impact of rising raw material prices, which could push up inflation. Also, the Eurozone crisis affects emerging markets through trade channel, but also possibly from credit channel, which was already said before. There could be also a temptation for some countries in the region to have put in place some protectionist measures, especially the countries which have a strong domestic market, to answer to external vulnerabilities. And the last thing is potential political tensions, like what happened in North Africa and Middle East. I'm thinking of Russia, where there was some social movements, but at a much lower scale, and definitely more controlled by the government there. Okay, the next slide. This one I will go. Next one, yeah. So again, what I said before, the emerging Asian countries should be able to handle external shocks, because first of the public debt. The public debt is very low. It's below 40% of GDP. If you compare to advanced economy, the public debt represents 110%. So you see a very big difference. So they have really room to act against potential deterioration. If you remember, China alone, they had dedicated 14% of their GDP to their 2009 stimulus. So that's really a lot. And all the more with you see on the graph on the right side, the amazing amount of foreign exchange reserves that emerging Asia has garnered. They have about $5,000 billion, which is more than half of the total emerging countries' reserves. Next slide. What we see is that also the Asian countries there's more and more interconnections among Asian countries. So the trade within the region is increasing rapidly. For instance, we have 18% of the regional exports that are directed to other regional countries, and China alone absorbs 5% of this trade. Nevertheless, the Eurozone crisis won't be without any consequence for emerging Asia. First, advanced economies are still the first partner of Asian economies. US, Japan, Eurozone represent more than 40% of Chinese export, for instance. And the US alone represents about almost 50% of world GDP. So they remain essential for Asian economies, especially for China, at the moment where their trade surplus is going down. And the second thing is about Europe. If you look at the direct exposure to the Eurozone for Asian countries, it looked quite small, 13% only. But I think this figure underestimates the transmission channel. Because what you don't see in the statistics is that many exports from, let's say, Southeast Asia can go to China for reprocessing, and then it's re-exported to end users, US and Europe. It's not in the stats, but if US and Europe stop buying from China, then it will have an indirect impact for sure on the other economies in the region. And it's not granted for sure that it could be offset by a significant improvement of domestic Asian consumption. Okay, next slide. The other channel is a channel that has been already mentioned several times. It's another crisis transmission channel is the credit channel provided by European banks. The trade finance has increased dramatically in the last 10 years to a total of $1,000 billion in June 2011, excluding China and India, representing 41% of the regional GDP. And if you take European banks, they've been very active in international project funding, project financing. It represents about 1/3 of the world trade finance. So you can imagine that if, European banks have to reduce their commitments, their exposure on Asia, there will be an impact on the projects currently financed, and there will be definitely an impact of the economic growth in Asia. The slowdown in 2012 could also lead to another risk, which is the increasing the dependency of South Asian countries to China. Because China is importing more and more from, there's been a free trade agreement signed in the beginning of 2010 with the ASEAN countries. And so it has definitely boosted the exports from ASEAN to China. But if there was a crisis, then if its situation deteriorated further, they would, the South Asian countries would be even more dependent on China, and they would be, in a way, dependent to Chinese choices in political, economic matters. So that's a risk we have to keep in mind. On China, because you cannot talk about Asia without talking about China, another risk is about the corporate, the banks lending or not lending to corporates in China. The credit has significantly decelerated since the end of the stimulus package implemented in 2009, and now what we see from 2009 to 2012. And because the government is wanted to also fight against inflation, and so the government now is hesitant to open back the credit taps. They don't want to feed the housing bubble, for instance, which is one of the major concerns today in China. But by doing that, well, it's also it's a big problem for the Chinese corporates to obtain funding from the banks.